Welcome to TheoTrade. This is Don Kaufman. Here we are. It is December 16th, 2017, just shy of the holidays here, doing the Theo weekend update. First and foremost, S&P's close all-time high in what can only be really described as some kind of manic trade on Friday, which I'm going to start, this weekend update with discussing just a little bit about some intraday trade. So those of you, if you do not necessarily look at intraday trade, that's all right. But, to use a phrase and throw it out there that it's, almost manic trade is, I think, throwing out, fairly large enchilada here early on. Let me show you precisely what I am talking about. What we're going to do is we're going to look at the S&P futures on, again, an intraday basis. So the S&P futures out of the gate are fairly strong. And again, this is specific to Friday's trade. They have these episodes where they're literally exploding higher. And you really have to look at this for what it is. These bars that I've now highlighted happen to be indicative of no more than, these are 1 minute candles. This is 1, 2, 3, 4 minutes to the upside. And you start to recognize, wow, these are upside moves. This is volatility, if you will, to the upside. And this is nothing short of spectacular. When you see almost a 10 handle move to the upside, we migrate back to the downside. The apparent aspect to me, this almost looks like, what would be characterized as sell side activity, except it's to the upside. Anyway, one of the things that really struck many of us that have been in this business for a long time is the succession of almost these kind of manic moves, followed by a wild move into the close, which took us from the 2682 handle right into the cash close. We dropped, again, almost 10 S&P points into the cash close, only to explode right back again later. And there's a lot of inexplicable moves that are going on inside of the marketplace. One thing before I go any further here. So again, before I go any further, one thing I really want to focus on happens to be expected move on the week. And then I'll talk a little bit about the week at large and what we can kind of expect moving forward. So if we take a look at the SPX, so what I kind of call the granddaddy of all the products out there, in terms of the SPX, we are looking at this line across that kind of bisects the screen. Well, that is none other than the expected move. Now, what I'm doing is zooming out. This is now a 9-month, daily chart. And each and every week, again, we kind of discuss expected moves. The previous week over here, a substantially larger expected move. This last week, in the mid $20 range for an expected move. And again, those expected moves are based specifically on the options premium. Okay, and that's every single week. We are forward looking with this. Okay, for example, today, this weekend, we'll take you a look into this coming week's expected move. There's just shy of about a $24 expected move. And again, that is forward looking. In fact, if you take a look at the chart, you'll actually see I've already drawn the expected moves into the future, which takes us right through kind of Christmas Day. So we're going to be coming into the holiday week. Anyway, with that being said, it is uncanny, all right, how accurate some of these expected moves happen to be. If you're taking a look at this with me right now, you'll see this kind of central line. That is where the week started. That's where the previous Friday right here, that's the previous Friday's close. This happens to be ultimately, this Friday's close. We hit the expected move within a few pennies. And this is something I keep pointing out, that we're edging right to the expected move, either reverting from it or closing on it on a Friday. How imperative it is, though, to be looking at these expected moves at this point in time. And when you start to look at this on intraday trade, one of the reasons that we probably saw this almost manic move to the downside just before the closing bell had everything to do, with keeping the risk inside what was expected. And again, this is not, people are like, it's manipulation, it's this, it's that. It has nothing more to do than hedging activity, There's a tremendous, amount of risk that exists outside of this barrier. Okay. Consequently, all right, consequently, what occurs very often is activity to drive the market back inside what we term as the expected move. What inside, what's expected out there. And I think that describes a lot of what went on at the cash close. What is inexplicable, however, happens to be these bursts to the upside, which again, really kind of manic moves. And there's a lot of kind of like mania throughout the marketplace that I'm going to bring you into here just a little bit later. So let's now go forward in the SPX, of course, to next week. And in doing that, again, as we stated, in the SPX in this coming week, we're looking at just shy of about a $24 move, either higher or lower. One of the aspects that is kind of striking to me in this coming week happens to be the lack of volatility. Now, everybody's like, listen, Don, volatility is low. I get it. What am I actually referencing, though, with the lack of volatility? Well, they're going to vote. Okay, the House and the Senate, they're going to actually vote once again on this combined tax plan. All the politics aside, neither here nor there. The aspect that's striking to me is that the marketplace, it isn't putting even the slightest probability of this not passing. I mean, if there was, why would we have, again, this happens to be none other than the Wednesday expiration. This is Wednesday of next week, December 20th. It's at 7.5%. That's like looking at the VIX at 7.5% for next Wednesday. And again, that's really accounting for zero chance that this tax bill does not pass. The other aspect about the tax bill that you really have to kind of fathom is that you would think that everything was priced in, all right? Like, all right, it's going to pass, and yet we still explode higher on that tax bill, or what we're going to show you here in a moment, what really drove the S&Ps momentarily. So again, we're looking right at around for the full week, this $24 expected move, which, listen, it's nothing unusual, okay? The one aspect, though, I do want you to think about is, coming into the holiday over here, it literally, the expected move falls almost dead into 2,700. To the downside, okay, it's right around the neighborhood here of 2,650 and change. So again, the expected move is nothing extraordinary by any means. We literally tagged the edge of the expected move in the SPX this past week. All right, so the only thing, again, really striking here is that it's, 2,700 on the nose. If we were to close there, I don't think I would necessarily be surprised. All right, flipping down to the Nasdaq. Okay, the Nasdaq, better known as the index that just drove the markets and specifically the S&Ps. One of the things that I often do, I don't just look at an expected move. I don't just look at like necessarily intraday trade. I try to find what really drives markets. Okay, when you started looking at this rally and you're like, wow, that's just an explosive move. 27 handles in the S&Ps on top of, everything else. It's just icing the cake over there. But I needed to know like what really caused this move. And it's not just, again, a kind of a vicious move to the upside here throughout the course of the week. The move in the NASDAQ was so relentless that it actually cracked through the edge of the expected move. But the NASDAQ is known to crack the expected move, statistically speaking, way more than the S&Ps. So if you zoom out over here, again, this is a 9-month daily, you'll see the NASDAQ, okay, consistently cracking through expected moves, whereas, and in a large part, whereas over in the S&Ps, it's a very, very rare occurrence. All right, so it's the NASDAQ specifically, though, that did drive us. And again, one of these things I always look for is like, what's the driver? What's the driver? So I saw the financials, but if you look at the financials throughout the course of the week, and this should have been spectacular news for the financials. I mean, really, here's where the week ultimately began and the week ending. And what did we do in the financials? Absolutely nothing. Okay, so I started looking around at some other major sectors out there. Like, all right, let's go look at energy. What did energy do in the week? In fact, to define the week, to make it a little easier, we can even look at the expected moves. All right, that's an auto expected move that I have in here. And the reason I'm using this is I just wanted you to see this is where the week began. This is where the week ended. What did we do? Absolutely nothing. In fact, the energy sector, it sold off ever so slightly on the week. And I can go on and on. So then I jumped over and I looked. I'm like, okay, so what else is driving the market over here? I looked at retail. All right. Did retail move the market? No. Retail was actually down in the week. Go fish. I mean, this is like a game I play all the time. So financials, for the most part, are what? Unchanged on the week. Energy's actually down slightly on the week. Okay. We looked over at the XRT. The XRT is the ETF, of course, for retail. That isn't doing much. I just kept going through ETF after ETF after ETF, and it really comes down to one thing. And it's this same exact subsector here, which happens to be none other than what? You can look at the XLK or you can look at the QQQ, but specifically, it's just technology. And even more specifically, okay, it happens to be a stock like Google. If you really want to know what's leading an entire rally of a marketplace, okay, you don't have to look that far. It's a stock like Google, all right? It's back to, once again, the fabulous five over here, what we kind of term the monsters of tech. And what you're looking at right now is a conglomerate symbol of the monsters of tech. And really, the last 2 weeks have had an explosive move, okay? So it really comes down, again, when all else fails and it looks like, 2 weeks ago, and a little longer than that, it looks like the monsters of tech are going to fall flat on their face. They rebound, take the S&Ps to all-time highs over there. One other aspect that I do want to cover, yesterday, there's no doubt that sectors across the board were strong on a relative basis, but most of those sectors were not, in fact, strong throughout the course of the week, which brings up one other aspect here. I'm going to bring up the XLF, which are the financials. And the reason, again, I'm looking at the financials so substantially is they had one of the most explosive moves in the entire market, right? And they also stand the most to gain, the most to lose from not only the FOMC meeting that happened this week, but of course the tax bill as well. Anyway, taking a look at the financials, nothing to see over here. Again, they're not pricing in a substantial move by any stretch of the imagination in this coming week of trade. All right. We're going to switch gears just a bit over here on you, and we're going to take a quick glance over at the VIX. All right, lots of people talking about the VIX. I'll remove the expected moves on the VIX. The VIX right back down, okay, into this kind of mid-9 handle. As I said, nothing really to see here. Low volatility. The aspect that's really striking, though, with this is again, and there's so many different things that, you traded for a long time. And I've got 20 years in the business now. And it's infrequent that you see so many different, I would consider, like, again, manic moves in a marketplace inside of a short period of time. Again, what am I looking at here in the VIX? So the VIX is contracting substantially, yet we're seeing incredible and explosive moves. And one of the things you can use to kind of describe this, I'm going to take all the expected moves off for just a moment. And forget about, expectations of movement, anything like that. If you come up to studies, go add study, go down to volatility studies and pull up historical volatility. This is the annualized standard deviation of past stock price movement. You're like, what does that mean? It's just measuring actual movement in the market. And I'm going to take this down to about a 5-day. Okay. So it's just averaging over the last 5 days. Hit apply, hit OK. So why am I bothering to show this, all right, to individuals? They're like, all right, so what exactly here, Don, are you showing me? Let me zoom back out, make it a little easier. What I'm showing you is the actual movement, okay? And if you look at historical volatility based on the last 5 days, the actual movement of markets in the last 5 days is about 7.6%, okay? Which is, like, all right, that's not like, astounding by any stretch of the imagination. But the interesting thing about that 7.6%, that's actual movement. It's mirroring almost perfectly the implied volatility. And quite frankly, I've never seen such efficiency to a marketplace before. What it basically means is the options, okay, are saying we're going to move at a rate of X. Okay, so let me think about this for a second. The options are saying we're going to move at a rate of X. The market is moving to X. That's it. I mean, that's all there is to it. If the market says, okay, options market says 7.5%, and guess what? The actual market is listening. Okay, and that's, again, there's absolutely no edge in the premiums right now of the SPX. That's kind of what it's dictating, at least in the current environment. Now, don't let that sound completely defeating. You know, markets often go from a period of incredible efficiency to, sheer inefficiency. And that's one of the reasons, I've probably used the phrase on this weekend update here, manic, time and again, because you're starting to see the level of efficiency. It's uncanny throughout the marketplace. Yet, the markets are still wild, and they're wild right now to the upside. Okay. And again, at this point, you got to start to think to yourself, something has got to give, because this becomes more and more difficult for any derivatives firm, right, to really crank out returns at that point in time when things are so tight, so efficient. It's hard to make even fractions of a penny and do it millions of times. And that's what most of these big trading firms are into. All right. Once again, I'm going to completely switch gears on you. We're going to cruise over, okay, momentarily to the bond market. The bond market is also throwing off a couple of odd signals in here. So I'm just going in here, adjust for contract changes, hit apply, hit OK. The bond market is anything what you would believe if you heard the Fed. So the Fed comes out this week, and what do they say? 6 more weeks of, winter over there. By the way, I absolutely compare Janet Yellen to Punxsutawney Phil. That's the groundhog, because every 6 weeks she comes out and says the exact same thing. 6 more weeks of winter. Anyway, the bonds have been on a pretty good tear to the upside lately, which is anything but what you would expect, because as the bonds go up, the yields, in fact, go down. But that's the longer duration bonds. Then we actually are going to take a quick glance at the notes. Now the notes, okay, are slipping down very, very slightly. So what this means is like the 10-year interest rates, okay, and the 30-year interest rates are actually moving in opposition. Think about that for a second. You saw the bond going up, okay, here's the note going down. Guess what? The interest rates are doing the exact same thing. And, I've been doing this a long time, and you look at the yield curve, and I don't want to get too much into the yield curve, but the differential between, and I'm going to kind of script this on the screen really quick. There's all different types of debt paper out there. There's 2-year, okay, and then there's 10-year. All right, there's 5-year in here. But one of the things that a lot of traders measure is the differential in the yield between the 2-year and the 10-year, and that one right now is sitting right around 0.55. What that basically means is if you lock your money up for 2 years, okay, versus 10 years, you only get, okay, 0.5% more for 10 years, which means this yield curve, and what the yield curve is, it's kind of plotting what yield looks like. If down here was, for instance, 1.5%, then it jumps to like 2%, then out here it's 2.3%. Between the 2-year and the 10-year, there's the only differential is 0.55%. It's crazy. Then you can actually look at even longer durations, and it's not much greater out there. So some wild things. One last thing I'm going to leave you with over here on this weekend update. You may or may not appreciate this. So a news blurb comes out just after the close on Friday, and they want to talk about mania in the market. So TD Ameritrade. Now, it's not often I'm going to pull up TD Ameritrade. I had tenure at TD Ameritrade for about 5 years. It's been it's coming into 3 years, my 3-year anniversary of being gone from TD Ameritrade. Nevertheless, I have to pull this up on this weekend update because, as I said, like the theme today is a little bit of mania in the marketplace. You want mania? Right after the bell, TD Ameritrade announces that they're going to allow Bitcoin futures to be traded, okay, on thinkorswim. So that's it. That's the announcement. And that the margin was going to be fairly substantial, but they're only allowing the CBOE futures to be traded. So you want to talk about Bitcoin mania? Let me just point something out for you for a second. In the aftermarket, TD Ameritrade shot up, Okay, the stock shot up. Why? Because they announced Bitcoin futures. It shot up into the amount of 2%. So it goes plus 2%. Do you realize that this, okay, is a $30 billion market cap? That's a $30 billion market cap that just moved 2% because they're going to allow people to trade Bitcoin futures. Need I say more? I want you to think about that one for a second, because the entire market cap of every cryptocurrency, okay, is still below what? About $500 billion. Still below $500 billion, yet just announcing that they're going to let people trade the product. Okay, a $30 billion company jumps by 2%. And that's when you have to start to question everything out there. That's what I'll leave you with. Have a wonderful weekend, everybody. Bye-bye.